Let's take a look at two different methods for accruing taxes and how they work. The first method, known as the coefficient method, requires an estimate of the amounts that are assessed or declared but which will probably not be collected. This is the coefficient. Let's assume this coefficient is on average 4% for personal income taxes. If the assessed amount was $10 billion, then to compile the accrual revenue, you would just deduct the amount not expected to be collected. Thus, accrual income tax equals assessed income tax multiplied by 1 minus 0.04, which is equal to $10 billion multiplied by 0.96, which is equal to $9.6 billion. Obviously, we will not know the actual coefficient until after a few years, namely when all the payments relating to the respective year have been received. So, for provisional and often even for final GFS estimates, the coefficient must be estimated based on historical information. The calculation can be based on average results for several years. The coefficient will need to be revised regularly to reflect changes in tax collection methods or other circumstances. In addition, the accrual revenue data should be revised once data for actual receipts has become available. The second method is the time adjustment method. It's based on actual cash receipts and thus requires no estimation of the amount that will be collected. However, an assessment is required of the typical time lag between when a tax obligation arises and when that tax is paid. Typical payment time lags should be calculated for each individual tax. Suppose that we look at payment patterns and see that on average corporate income taxes are paid with a delay of 2 months. That means taxes related to income generated in January are usually paid in March. This information allows us to make a simple adjustment to the cash receipts data to arrive at the accrued revenue. The cash amounts collected in January and February of one year will simply be included in the annual accrual revenue of the previous year. This implies, of course, that you need to wait until March, at least, to be able to report final revenue data for the previous year. Which of these methods is used in practice will depend on various considerations. If the time lag between the economic event and the cash payments is consistent and relatively stable, for example 2 months, the time-adjusted cash method is a sensible and reliable approach. If, however, the delays vary and correlate with individual circumstances, the coefficient method may yield better results. A detailed assessment of the legal conditions and actual payment patterns for the main tax categories should guide your methodological choice.